Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Okay, here we go. So welcome to our weekly research meeting for, it's almost the end of April now. So it's tax day. I forget, when do we start working for ourselves again? I think that's in August sometime. But anyways, lots of tax money going in today to keep this wonderful country of ours going. Over to you, Joe.
Yeah, indeed. Yeah, thanks a lot. Happy April 30th. Just an update from PL Cap and then diving into charts of the week. Disclaimer as always, and just ask you to focus on that for a sec. So let's get into PL Cap. They are, PL Capital is a company name. They have a fund called the Financial Edge Fund. And the idea here is really the kind of mid to upper layer of the U.S. Banking system. So this is not Bank of America and JP Morgan. It's sort of underneath that, but right up top over some of the regional banks that failed. We'll talk about that. They did outperform the NASDAQ and S&P. They outperformed the S&P 500 in the first quarter, and trailed the NASDAQ banking index by 30 basis points. But you can see, since inception, they do provide some value, although I think the value relative to the S&P is not so much on the return side as much as the risk side. This is a really interesting table here. Our range of experiences with the banking system as far as investments go is let's call it, there's been a diversified array of outcomes there. But certainly when you look at banks in general, they are quite profitable. And you might not have thought of this because of, OpenAI and sort of looks like Sam Altman and Elon are having a bit of a, lovers quarrel online. But you can see here since 2008. So even if you kind of say, okay, 2008 was the global financial crisis. If you skip ahead to 2010, industry profits at 88 billion, they pretty much grew straight up until 23. They took a little bit of dip on the some of the regional banking failures there. But you're still talking about an industry that's pumping out for the last several years, 250 billion plus in profits to investors, and assets last year clipped 25 trillion. So it's interesting how they track that data. And this is sort of a new investment for myself in terms of PL Caps. I did spend time reading through their deck. They've actually been in business for quite a long time. From a valuation perspective, some of these small cap banks, and just sort of as a comment, the definition of a small cap bank for the United States could be still pretty good size, but you can see here there is a pretty good gap between the valuation of these small cap U.S. banks relative to the S&P 500. So you've got kind of a moat built up over there, as well as on a relative PE ratio basis. So maybe if you're transitioning out of a growth style into value, these banks do provide some good opportunities there. Why does he bring up West Texas Intermediate? I actually think this is really insightful because it speaks directly to kind of what's going on in WTI. So everyone's talking about Iran and the Strait of Hormuz. People that don't even know where Persia is know about the Strait of Hormuz now. WTI spot and near-term futures, they sort of spiked up, not because there's a shortage of oil in the United States. The U.S. apparently has, I don't know how they did it, but apparently, according to their report, they have enough oil, more than enough. But it's actually being acquired by foreign buyers who cannot get product in some of their supply chains coming out of the Middle East due to the conflict. And so because they're paying huge premiums for that product, that WTI, petroleum distillates and products like that, diesel especially, and then shipping it to Asia, you have this sort of brief, what PLCAP says, spike in spot prices. But then some of the subsequent forward-looking futures contract prices are kind of sloping down. And so, the longer you get a sustained increase in uh, energy prices, I mean, that's inflationary, and no one's going to tell me otherwise. I actually just filled up one of my vehicles last week here in the east end of Toronto, and there was a guy probably half my age filling up a pickup truck, looks like a tradesman. It was $265 to fill it up, and so that's how you stack these margins, and it does impact them. So let's just take a look at some of the holdings. These are not intended to be individual stock picks, but a lot of their holdings are in the public markets. So you've got Bank of California here on a 5-year basis. Looks like a typical bank chart. This company here, financial institutions, also traded on the Nasdaq. 6.5%. I think these are price returns, so these may exclude any of the divvies that you might collect on these companies. You've got Enterprise Financial Services Corp is another one, and Horizon Bank Corp. I'd be a little bit upset if I was down after 5 years, but it is what it is. And then First Merchants Corp is another one of their holdings. These are mainly their top positions in the fund as of the end of Q1 26. NBT Bank Corp is another one, and FNB Corp. That one looks pretty good, up 36% over the last 5 years. And then we get into charts of the week. So, with Andrew, I think everybody was kind of looking at Jay Powell's final meeting. Sounds like it was pretty much right off the script with not a lot of ad-libbing. So right on track for that. I didn't actually know that Powell's going to remain on the board. I'm not saying I'm surprised. I just didn't know about that. And so what he's saying, that from a stock market perspective, I know it looks like the market rebounded from the lows in April and then kind of popped up, and now it's looking like it's turning around. He thinks this is more kind of bullish consolidation rather than anything worse than that. And sorry, my cursor's just frozen up there. So here's the S&P 500. As I say, it came down in March, popped back up in first couple of weeks of April there, and then boom, it hit the upper rev limiter there, that second standard deviation line, and this graph looks like I don't know if you guys remember, but there was a ball player for the Jays called Fred McGriff, and he was a crusher, but his home runs would pretty much go straight up and wait for the earth to rotate underneath it and then land in the bleachers. So that's kind of what that looks like there. Looks like more of the same for the Nasdaq, except this is a pretty obvious break through that upper line there. So this is a pretty good movement here. Looks like the Nasdaq could have some legs here. There is a chart coming up with the stocks in a moment. Small caps, on the other hand, looks like they kind of followed the lead from the market, and then maybe ran out of gas or something. Who knows what happened there? I didn't check the U.S. 10-year yield before. I didn't check any of the U.S. Treasury yields before this meeting, so it could be that maybe some of those yields are popping up on inflation concerns, and small caps don't like that too much. But as I say, we've trimmed back our small cap exposure a lot. And so back to our old friend crude oil here. What he says is the most fascinating part of the rally to him over the past month is that the gains in stocks have been kind of like mirrored, I guess, by an uptick in oil. And so now oil prices are kind of back at these high levels. And sorry, that's Sean. Yeah, they're great. Thank you. And so despite some of the assumptions that the worst is behind us, as I mentioned, there are some different ways of looking at oil longer term. I think what he also writes in the written portion is if you didn't get into oil or oil and gas stocks yet, you kind of want to be careful doing that right now. Okay, so this is the semiconductor index, Philly Sox index. Andrew, so it kind of went on this 18-day winning streak, which you really noticed in some of the AI and tech and optical type stocks. The optical stocks moved a lot in particular, and then they kind of hit that upper line and sold off a little bit. Andrew would prefer to see a little bit more of a cooling period to where that green bubble is. That's the 38.2% Fibonacci retracement, aka the first retracement line. And he has in the last maybe couple of years used that as a target zone to kind of maybe let the circuit boards cool down a bit. U.S. 10-year, speak of the devil. Yeah, it did actually on the right-hand side there in April, May, pop out of that channel. So maybe that's what small caps didn't like. And I think there's one more here, gold and silver. So we talked about gold and silver late last night. There are other metals year to date 26, they're outperforming it. Copper and uranium certainly stick out. But with gold and silver, you're going through this period where there's a bit of a sell-off. And, again, a lot of investors are kind of scratching their heads saying, well, I thought gold and, these sorts of things did well when there's geopolitical risk. They do, but again, gold and silver have gone on these pretty big runs. Like I check silver every day when I have my coffee, and I think it's kind of between 70 and 80 bucks right now, which is certainly off the highs from a couple of months back, but it's also still more than double the 5-year moving average. So what he's getting at, what Andrew is getting at, is that he doesn't really have a good sense of where it might go next. And so I think he's kind of letting it play out. But the issue here with gold is that if you don't get some stabilization or some traction around 4,400, 4,500, you do kind of start to build a case where it could dip down to 4,000. I think that's unlikely, but it is what it is, and that's it for me. Back to you guys.
Awesome, Joe.
Yeah, sorry. Thanks, Joe. I couldn't get the mute button. Go for it, Ken.
Screen. April 30th. Just the disclaimer on the Canadian side for our Canadian investors, just contact us. And then same for the US, just contact us via email or our website, just not making any securities advice here. Looking quickly, I'll be pretty brief, I think, on a couple of these charts. The S&P 500, really no change week over week. There is no near-term support after the bounce back that we've seen over the last 3 to 4 weeks now. Vertical price objective continues to move higher. This week was relatively flat. The peace talks are kind of up in the air. Ceasefire, etc. And then even OpenAI, the market pulled back on their milestone misses report from the Wall Street Journal. So kind of a really flat week. Overbought, oversold remains elevated. It's been elevated the last 3 weeks after a sustained selling pressure over the previous 7-day weeks. So watching that closely. Kind of same thing with the NASDAQ, except a 2-box increase. Second straight week. It's been at an all-time high on the chart. Last week or so, it's been led by energy and hyperscalers. Kind of same story with the S&P, no near-term support. Elevated demands via the overbought, oversold indicator. It's actually the 3rd straight week it's been heavily overbought, which is the first time that's happened since September/October. So Perhaps a little more return from investors into the growth trade, but we'll have to see. Looking here at the Dow, $5 decrease week over week, $5 from support now. It did not reach the all-time high like the growth indices did over the last few weeks. For a lot of the Dow components, really a weak week with that pullback you can see. And then the overbought, oversold kind of reflects that as well, which is actually at the lowest level it's been at in 3 weeks. But it is the third straight week it's been overbought, and that's the first occurrence we've had for the Dow since pre-conflict in Iran. Now looking here at the TSX 60, $5 decrease over the week. Very weak week for commodity producers and even Canadian financials. It is moving towards the support lines there. You can see they're $9 and $12 is lower. Overbought, oversold. It's the lowest in 5 weeks. First time the TSX overbought has been lower than the US indices in a few months. So kind of perhaps a bit of rotation, perhaps a bit of profit taking north of the border. We'll have to see if that's a sustained trend that we see. Looking here at the VIX, a bit of a tick up at the end of the week, but overall it's decreased over the week. And the target price has moved lower to 14%. It seems like the upward trend that we had for about 3 to 4 months at the start of the year is completely reversed over the last few weeks since the VIX has spiked. I'll flip through these very quickly. No changes in the bullish percentage charts really of note. Percent positive trend, same thing. And then the TSX 60 as well. So we'll probably talk about those next week. Asset class rankings, really a rotation into the equity groups you can see here with commodities pulling back, driven by energy and precious metals. Very surprising that energy lost some buy signals. I think probably some profit taking. Looking down in the currencies, US dollars out of the bottom position for the first time since the second month of the Trump 2.0 presidency. So that uncertainty, the price of gold pulling back, the conflict, a bit of a rotation into US assets, giving the US some strength this year, especially relative to the developed market currencies, as you can see on these rankings. And then up in domestic equities, tech number 2, jumping up pretty substantially this week. I did mention the hyperscalers had a pretty good week. Perhaps some of that risk-on mindset from investors is back, kind of being reflected with that movement over the last 2 weeks or so. Looking here, this is just a chart from Dorsey Wright that tracks bull market outcomes. They illustrate this by the performance of all 12 bull markets since 1949. The shortest of them last around 2 years and can gain as little as 50%. Conversely, they can also last over a decade. You can see all of the green one. I should have labeled them, but they didn't have a legend, so I didn't create one. But the longest term one was from 88 to 2000, and they classified the current one starting basically at the end of that sell-off from 2022. But the current one, I think, is sitting at about just over 3.3 years and a quarter. So right now we're sitting on about 100% gain. Historically, the historical averages would say we're kind of stretching out that bull market average, but if you do look at the long-term bull markets, perhaps a lot more upside, and that's basically where their technical charts this week were displaying more technical upside for these global indices. Just looking here at Microsoft, obviously a large component of all of these indices. We've talked about the pullback. We don't really hold this at all, but just the substantial pullback that we saw at the start of this year really started in the fall but we've seemed to have found a bottom for Microsoft and a complete reversal. So really watching it closely, especially as earnings are released. This week, perhaps a little worry with the just OpenAI's milestone misses and perhaps delayed revenue, slower growth, and Microsoft's investment and stake in OpenAI, but that's something that we'll have to obviously continue to follow. This is just a chart that tracks bull markets where the S&P 500 has doubled. You can see the start date, when it took to double, and then the end date of the bull market. You can see on average after doubling is about 3 years and about 79% of gains left. So obviously history doesn't always repeat itself. You shouldn't build your investment portfolio purely on a historical scenario analysis, but just showing some of these charts on overall bull market cycles, especially where we are in the current bull market. And then just showing this chart. This is from the Financial Times. I read an article this week. The chart's sourced to the IEA and World Bank, but the current loss of oil supply is the biggest of them all since the 70s. The initial loss is quite substantial, almost 10 million barrels per day. And there's worry that that could continue, and the real impact will be seen in the coming months, especially as vessels have basically ground, or vessel traffic is essentially ground to a halt over the past 6-7 weeks. It has picked up a little with the ceasefire, but really nowhere near the level it was before. And that obviously is reflected in the price of crude, which is still sitting at $100, even with the UAE leaving OPEC, a ceasefire being announced, just a lot of uncertainty in the price of oil. I think that's why we're gonna have the price of oil staying pretty elevated, for unless there's a long-term resolution, which doesn't seem like there will be one right now, which is where a lot of these energy companies are going to be quite attractive, and we continue to look at a number of opportunities there. And then just tracking here, this is OPEC. Obviously, I mentioned the UAE leaving OPEC as of tomorrow, I guess, but OPEC's power really decreased. Trump obviously has long been very critical of OPEC, so have a number of other individuals, but OPEC has slowly lost its power as the U.S. has really ramped up its production of crude. Qatar left the organization in 2019. The UAE, which is I think the third or fourth largest producer in OPEC, is leaving this year so they can increase their production. OPEC's power is going to continue to deteriorate, especially moving forward, and especially as countries slowly decrease their not overall use of oil, but their percentage of energy consumed. That share that it's oil obviously has decreased over time. And then this is obviously the chart that reflects why UAE is leaving OPEC. They've built a tremendous amount of spare capacity. They're one of the only countries that has a lot of spare capacity. They're one of OPEC's only nations that also have that spare capacity. And in the future, if obviously the Strait of Hormuz is something different, but they'll be able to adjust production to address some sort of oil shock in the future and help tame that. Right now, I think their quota is about 3.3 million barrels, and that they have capacity that could reach up to 5 million. And OPEC has been very resistant to increase their production in recent years. So, kind of them leaving takes their quote unquote shackles off. And then just looking here, complete typo by the analyst here, I just realized, but central bank gold purchases, this is a long-term chart, obviously, back to 2019. 2026's number is estimated at this point. I think it's prorated. But remains robust. Obviously, the price of gold has pulled back. It's worrying many investors. We continue to remain long in gold, but obviously the price pulling back has caused some investors to take some profits. We still think inflation is a real issue, and gold can help hedge that. Obviously, the price of oil moving up pretty substantially is going to cause some inflation numbers to rise through the end of this year. So perhaps now with gold pulling back, some entry points for investors with minimal exposure. And that's it for me.
Okay, Ken, thanks. Good typo on that last gold slide. Change the typo to precision central bankers.
Yeah.
Man, there's no such thing. It's an oxymoron. None of them are precision. They're all hindsight people. Okay, I'll get going on a few things here and then pass it over to Sean. And anybody else joined us since I looked? Nope. Okay, good. I'm much happier using this MS Teams. It's just, I don't know, you just get one better than the other. And this doesn't take all the memory that that other one was taking. Okay, I'll start with this video from Dorsey Wright.
Hello guys, my name is Anthony Garcia and I'll be going through the morning brief for April 29th on Wednesday. For starters, if we look at the performance over the past day, we did see that the equity indices were down slightly over the past day. We did see crude oil up 3.69%, so it's definitely an area that has been a bit volatile in recent weeks, but has continued to tick higher nonetheless. We did see gold continuous be the worst performing area of the market, and it was down 1.8% through yesterday's close. If we look at the S&P 500, we did see that it completed a bearish signal reversal in a strong column of X's after reaching a yearly low of 63.50. The S&P sits near all-time highs above 71.50, or sort of in that territory right now. So we've seen a nice and strong rebound for the equity index this year after facing some volatility in Q1. And then when looking at the Russell 2000, we see, once again, reverse back into X's, completed that triple top break and has continued to move up through various levels of resistance. The index is up 11% year to date in all-time high territory, moved down a little bit, but still in that all-time high territory. So we've not only seen an improvement from large cap equities, but also from small cap equities, respectively. And then when looking at the Dow Jones Industrial Average, you see that it also improved significantly, completing 3 consecutive buy signals before reversing back into O's. So you can see it faced some strong resistance at 49,800. So this area between 49,600 and 49,800 tends to be a pretty notable area of resistance. We've seen, several times that the index has moved up to this level and hasn't been able to quite move past that. You saw that, you saw various levels of resistance hitting that level at 49,400 before ultimately moving up slightly and then, reversing back down. So this is definitely a notable area to watch going forward. And then for emerging markets, this has once again been one of the strongest areas of the market. International equity still leading in the asset class group scores, in the Dolly page. And that's because, areas like emerging markets have, sort of maintained their strength even throughout quarter one of 2026. We did see a pullback into a column of O's, but, reverse right back up to near its all-time highs, and it's definitely benefiting from that strong momentum we saw in 2025. And then when looking at gold, this has been an area that when we first started 2026, it was a very, very strong performing area, a lot of upside. We were able to experience and capture. But we have seen it pull back significantly in recent weeks. Still up 6% year to date, but that's much lower than its level where its yearly high of 5,550. So it's definitely an area you wanted to monitor if you have some exposure, and continue to monitor for further technical deterioration. I mean, looking at at the Spider Gold Trust, you see that it completed a sell signal at 420 right here. It's just kind of declined, rather significantly from its March highs. So continue to monitor this area, especially if you have exposure there. It does have a weak fund score of 2.85. So this would kind of be the time where you could consider taking some off the table. And then the next fund that I'll highlight is XLK. Similar to a lot of those large equity indices, we did see it reverse back into X's, complete that double top break at 146, and now in all-time high territory at 160. Has a strong fund score of 5.6 with a strong score direction of 2.13. You can see that it recently reversed back into X's against the S&P 500 equal weight. And also for communication services, hasn't improved as much as technology. However, we did see it reverse back into X's near all-time high territory, facing resistance at 120. That's because over the past few weeks, we have seen more of those risk-on areas improve. We did see XLK for, let's say a few months. The technology sector for a few months was in the fourth position out of that top three, which is something that has been quite rare over the past few years, given the nature of technology and its growth over the past few years. But we did see it move back up into the second position over the past few weeks, highlighting how more of those risk-on areas are starting to improve and re-emerge once again. But that's all for me this week. We'll be back tomorrow with the next update. Thank you so much.
Okay. So that came through nicely. I just want to check for one thing before I continue on. Yes, this one. Okay, I'll do that at the end of my talk. So now I'm going to do Michael Kulba. Okay. These just came in. I had not read them. Starts off with wheat futures. After a failed breakout attempt in early March, wheat finally looks to be powering higher as commodity markets come to the realization that disruptions to global energy markets are likely to persist. Oh, and speculators are still short. Okay. Corn is yet to officially break out, but it is close. We're watching closely to see if this is confirmed trend change. Soybeans. We talked about soybeans going back to last year, as that seems to be President Trump's favorite bargaining chip in trade negotiations with China. I don't like this one as much as wheat or corn, but a confirmed trend change is certainly supportive of higher prices. Okay, S&P 500 earnings revisions. Earnings estimates have moved higher by 10% since the beginning of the year. 70% of that has come from technology, and that's it. So a real quick one today. No, nothing else hiding there. And then I will do the, actually I'm going to come back to that one at the end. I will do the watch list. So starting with the Canadian, the US dollar, no change, still at 73 cents, and with the same short-term target of 69 and long-term target of 62. That runs in the face of this one's change. The most important one, the US dollar spot index, the ICE, is at 99 right now, measures down to 95. So that's after going up a little bit year to date. Looks like it might be coming off again. So that's what the US wants. Okay, that's enough for currencies. And we've already heard quite a bit about energy, but I'll just continue on that one. Crude oil at 107 measures to 137. So this is a mathematical calculation. It's a vertical price objective. Crude's already up 86% this year. This just tells me that the trend appears to be up still, according to the mathematics of point and figure supply and demand analysis. Nat gas flat. The producers look to measure down. Copper slightly up. Uranium, this is a change, measuring down now. Gold flat on the futures and slightly down on the spot, whereas the gold bug index looks to be somewhat flat there. And then the other producers down, well, excuse me, down for both the majors, down for the juniors, down for silver. Yeah, so the whole precious metal complex has changed, as that analyst told us a while ago. The problem with this is it's very hard to trade, especially the actual physical miners that you own. So yeah, we'll be watching this carefully, and this might be just a temporary phenomenon. Yeah, platinum slightly up. Okay, so it looks like in the crypto space, and we'll hear from Sean more about this, I'm sure, but Bitcoin still has a downward target of 22,600. Ethereum is up, Solana way up, and the crypto index way up. So everything other than Bitcoin looks to be strong in that crypto space. So we shall see. The money center banks measure up, and the regional banks that Joe covered earlier measure up considerably from 70 to 90, as do the Canadian banks, still look very, very strong. So we'll have to continue to look at adding there. The brokers look strong in the US. And now finishing up with interest rates, and then I'm going to go over one of our outlier analysts' forecasts. The 2-year, no change there at 384 down to 275. The 5-year measures up, the 10-year up, and the 30-year big up. So we're back into what I think is an inflationary yield curve, and they can tinker with the short end. There's some evidence that they have bought on the long end and in the mortgage market, but they just don't have enough capital, in my opinion, to control those markets. They can move short-term rates considerably with all of their effects, but the yield curve at the mid to long end, the economy dictates that, and we shall see. Okay, David Hunter, not sure if you all read his recent report. I spent some time on the weekend just putting all the data manually into a spreadsheet, and this left column here is the current pricing for all of these indices and commodities and EFTs, and the next column is David Hunter's forecasts, and then finally these are the crazy upsides. So he sees the S&P going to 9,500, or up 33%, and he's talking about very short time frames on this too. I didn't bother writing down the time frame for everything, but he's talking about by the summer for this. So yeah, who knows? He's one of these long-term wave. I don't know if you'd call him a contrarian wave person or what, but he has a lot of conviction in this. I also went a little further and showed what NASDAQ Dorsey Wright, the point and figure group that we rely on a fair bit, they've got some astronomical targets too, according to their bullish price objectives. 10,600 for the S&P 500, up almost 50%, and so on. So the only one that they have a negative review on is the Dow, and that's just the chart of that has not been as consistently up as these technology-based ones have. Even the small cap RUT measures up 36% for Hunter, 24% for this. So yeah, I don't know. I wouldn't bet my whole wallet on any of these predictions. These are probably outliers, but it's showing that the trend could be like this. The US dollar spot index, or the ICE. Can someone let in Paul there, or I will. So US dollar spot index is at 98 right now. I just showed you a second ago. Measures down to 90 according to him, and 82. So he's calling for a serious down in the US dollar spot index against the rest of the world. Whereas I showed you a moment ago, Dorsey Wright measures it down to 95 or down 3.6%. Last year, this was a big moving vehicle. I think it had one of its sharpest declines since the 70s, I believe. It was down 12%. And this is exactly what Trump did in his first year in office, was drive down the US dollar spot index. Gives him some more breathing room with all of the amount of other money flows that they're constantly working on. And then there's a bunch of other currencies I'll stay away from, except for the Canadian dollar. It's 73 cents now. Hunter measures it going quite a bit higher, and you have to read his words, but that's just his prediction, is a 90-cent Canadian dollar, which would really hurt our US holdings. So we'll have to pay attention to that, whereas Dorsey Wright, as I told you a moment ago, measures it down. And then so on. I'm not going to go through all of these with everybody else. Actually, just email me if you'd like to get a copy of this spreadsheet. I'd be happy to share it. His 10-year prediction is down to 2.5%. Like, this is in an inflationary environment, like I just showed you on the forward views, he's got it down to 2.5. This one I find the hardest to believe, and he's got it down to 0% by, I think it was next year, I believe he said, whereas Dorsey Wright has it up to almost 5% and up 15%. So there's discrepancies there. And then I don't think he's done this before, but he's gone through and shown the NASDAQ, or the QQQs, I should say, and then all of these other ETFs and what they look like. And as you can see, they're all extremely positive. Really extreme bull here until he calls for a tremendous setback after this peak of 9,500 or close to it is hit for the S&P. So who knows? It's just one man's opinion out of millions of people's opinions in these markets. So have to decide which way things will go. But yeah, I'm not going to take anything away from that other than just announcing that. Okay, I think I'm done now, Sean. Are you ready to go? I didn't, the morning coffee didn't come in time to show everybody, so I might do that at the end if necessary. So Sean, take it away.
Okay, I'm going to stay off camera because I'm not feeling great and I look like hell.
Okay.
Trying to get my screen here. Well, this is not easy.
If you email it to me, I can put it on the screen.
I've emailed it this morning. You should have
okay.
it.
Let me find it.
Yeah, this is a little different than the last system I've got. Why can I not just throw this up? Huh, interesting. Clicking
Okay,
on share, and now I'm looking for PowerPoint. Oh, now I see it. All right, I think I got it. Do you guys see the screen?
Okay. Yes.
Okay, so macro overview, getting into it. Look, the returns, my returns are not great. I've been tilting a little bit at this market. The equity market is running higher. I think we're due for a correction here, but it's being driven more and more by the Mag 7 again, and probably mainly just Google and NVIDIA and the suppliers to that, including SanDisk and Western Digital and the like, Micron. Investment themes, the big thing is still the war, right? And what's going on? I think the blockade is working. It's a blockade over bombs. It seems to be a smarter decision as time goes on. So asset classes,
okay.
We've seen gold come off. We've seen Bitcoin come off. Ether's come off. I just don't like crypto. I keep saying that over and over. Brent's up 9%. Typically, when we see oil go up over 50% in a short period of time, we have a recession, but I think the risk is growing, but we're not there yet. Economics, no real change except this idea of stagflation is getting more and more entrenched. Oil prices are elevated. People are talking about the knock on through the supply chain even more. Fertilizers, diesel, and so on. Growth has just come in at 2%. The Atlanta, a little bit above where the Atlanta Fed had predicted it would be. Overall, we're technically still in expansionary conditions. Again, recession doesn't seem to be imminent, but probabilistically, the risk is rising. The US dollar just going sideways right now. It's flip-flopping between risk aversion and the expectation that the US will be printing and heading towards lower interest rates. You know, that guy that's saying that the 10-year is going to go to zero, I think he should be committed. That is the craziest thing I've ever seen. Gold, you know, like everyone has said, we're now entering negative momentum. If you look at the heat map, which is the blue, the yellow, the green in the middle of the chart, it's showing that it's below the positive momentum or positive forward Sharpe ratio environment. And that's pretty much started kicking on, you know, in late March. So, you know, flip-flopping a little bit, but ever since that the margin revisioning by the CME, gold has been challenged, right? They've taken out a speculative lever for this asset. However, I do think long-term that gold holds its value. Of course, I can be wrong, but this is still a very strong underlying bullish trend, which is the green 200-day simple moving average. But right now, what are we seeing? We're seeing deleveraging. You know, I've heard from people who have dealings with customers in the Middle East that they're getting called on margin all over the place. And I think that there's a deleveraging happening out of Middle East banks related to real estate there. Silver, same thing, a related trade. However, I do think the demand for long-term silver is quite good. Again, we're just challenged and we're seeing a deleveraging across the investment asset space. Oil's about war. What's going on? You know, they're trying to fill up the tanks and calcify the Iranian production system. They're trying to fill the tanks and let these guys realize if this fills and the moisture changes and this oil hardens, that they are going to put the country back quite a bit, like 6 months to a year in the ability to start reproducing past flows and generating revenue to pay their army. And you know, everything I've learned is that the Republican Guard is really who is in charge of the economy. The front men are the mullahs, and the guys that make the money is this self-funding army. And when they are no longer self-funding because they can't export, they can't import, and now their main product is being, you know, suffering sclerosis, what are they going to do? They're probably going to come back to the table with a reasonable offer. And then if not, the U.S. can hit them again. But the blockade over bombing seems to be working. Rates and credit, pretty boring. Like I looked at this thing for the past year, the past 5 years. It's pretty boring. Well, what's the good news? Well, Warsh is coming in. Powell's going to stay on board, but as a governor, he's going to like be, you know, just take responsibility for these cost overrun allegations, and then he'll leave after that. You know, let's remember, Warsh and Bessent worked together under one of the greatest investors ever, Stanley Druckenmiller. This is a dream team for investors in the United States of America. They are going to make sure that we essentially have some form of a bullish market as long as the two of them get to work together. You know, and Paul Tudor Jones, another great all-time investor, noted how high the U.S. market cap is to GDP. You know, one of Buffett's four favorite ratios, and it's at an all-time high. And he thinks if we get back to if we have some mean reversion, it could result in like a 35% correction. It seems like 20% where correction goes into a bear market is a line in the sand for the administration. We saw that in the tariff tantrum. When we got to down 19%, basically Trump turtled, and I think he was directed to do so because he knows that if the equity market tanks, Americans are going to pay attention. We're still in the greed state, you know, across the trend indicators. They're pretty much all go. We've seen a pause in some of the very shortest term indicators, you know, 3 to 10 days. Breadth is looking pretty good. The VIX term structure is normal. The earnings trend, you know, the big one was Google, you know, and the sentiment is still positive. Here we see the S&P, just a ripping recovery that has seemed to hit like a bit of a pause at 71.30 right now. Just looking at the futures right now, 71.81. Okay. I expect this big gap around 6,600, 6,700 to get filled. You know, I've been wrong a lot in the last year, so take that for what it's worth. But this was a recovery unlike many others. And I guess I throw that up here with this slide. Unbelievable. We were just ripped through resistance at 6,900, 7,000. All systems basically are go. We see a tinge of red in the heat map, but that's like, again, the very short term. But across my trend heat map and across the breadth heat map at the bottom, all systems are go. And we're not in an extreme RSI. The blue line in the middle, called pressure, is a market-weighted RSI that I've created. And I just felt like RSI as it existed wasn't my favorite. I wanted something a little bit more concentrated. And that's showing like we potentially even have room to go higher. But the trend is a little bit down after that ripping rally. And I've repeated this for the last 3 weeks. Hedge them now. This rally's been a gift to investors to assess their current positioning. You know, I've unsuccessfully had these trades on a 1% put spread on the S&P or SPYs. You know, you buy the 700, you sell the 680s. On a 1 to 3% allocation of SPY puts for 3 months at 660. You know, if we do get the correction, which I think is possible, this will protect your portfolio pretty well. I mean, we've got the VIX sitting here sub 20. And when I play like the potential scenarios of the war being over or the war continuing, I think this solves a lot. It ameliorates a lot of the risk. Crypto is broken. It's in a basing pattern. It's going to bounce around 75,000. It's just a broken risk asset. Like these politicians are not getting the Clarity Act done. Tom Tillis is the guy that's the big stick in the mud on this. He was the asshole that basically was going to hold up the Warsh nomination unless the DOJ investigation was dropped, and then they dropped it. And I think they're going to go after him with a bit of a quid pro quo to say like, okay, we did what you wanted. You know, you got all this attention. Now we need this Clarity Act passed. Why do they need it passed? Because stable coins are the foundational mechanism going forward for the US to fund their deficit. Okay, they can't count on Japan. They can't count on the UK. They can't count on the petrodollar system anymore to buy up treasuries with their exorbitant privilege. And they've realized that if they allow stable coins to become the US dollar hegemonic instrument of the world, and by the laws that they've passed so far, they've said if you're going to be a legal stablecoin, you have to hold US treasuries 1-for-1, right? So they're giving that company Tether exorbitant privilege. It's an unbelievable act. And let's remember, Howard Lutnick, his company, Cantor Fitzgerald, owns a percentage of the company Tether, right? This is going to happen. They're going to be bending arms. But Tom Tillis is in one ear. He's got Brian Moynihan from Bank of America telling him, like, this is going to kill the American banking system because the crypto system, as you guys are putting it forward, is better. That's unbelievable. And in the other ear, he's hearing, like, from Besant and soon from Warsh is, we need this because this is how we're going to fund the debt. If they don't get this, I think you're going to see yields go higher, like a 0% on the 10-year. I mean, I just find that unbelievable. Like, I'm willing to eat my words, but I just don't think that that's in the cards. So here we see Bitcoin, my catchphrase right now, who needs Bitcoin? I don't know. We've had a 40% drawdown, and it's just flipping around on the probability that the Clarity Act gets done. And here's the cartoon for the day. Trump saying to Musk, okay, I like you again, where the Gigafactory is just churning out the Optimus robots, but they stuck Trump's head on them. There we go. That's it for me today.
Great. I got to find some time to see how you do those cartoons. That's great. Is Paul Beatty gone now? Yeah. Okay. Got to commit for this or not. I don't know what's happening with Chris Curry. Gilbert, do you want to wrap things up?
Sure. Give me 1 second here. It's going to be a quick one, I think. All right, can you guys see my screen? Yep. Okay, this is this week's short report. Again, here's the disclaimer. A quick one here, just a long-term view of the S&P 500, again, with that 200-week exponential moving average there as the long-term base we've seen during many material pullbacks, not the most recent one. What I want to focus on this week really is just looking at the top in 2000, right? And we had similar sort of moves here. In 1998, there was long-term capital management, which was a material sharp decline, similar to what we saw in 2025 with the tariff tantrum. New all-time highs subsequent to that, pullback, and then a material high. But really, it was a choppy sort of back and forth. And that sort of scenario is entirely possible here, given the technical setup that we have. Putting this into perspective here with the CAPE ratio, we're not that far from the highs that we saw in 2000 at the dot-com peak here. And so I just put that red line there across just to put some perspective here with regards to that. It did take some time. I mean, it took almost a year for the market to roll over once we got that high, but there was a lot of choppy back and forth sideways action. And a lot of these rallies, especially the one that we just had, are very seductive, I think, because if you can get 10% in about a month, right? It really does make you feel like you're missing out, especially at the top here. Market breadth, we're not seeing too much here with regards to market breadth. We're right in the middle here at around 55% of stocks trading above their 200-day exponential moving average. So you can't really look at this in terms of long-term market extremes one way or another. And finally, defense versus growth here. This is a shorter term look. Again, we're looking deep here at a rotation back into growth. But why I want to point this out is because when you look back at 2000, you can see we're actually more extended in terms of growth relative to defensive consumer staples here than we were at the height and in 2000, 2001 here before the market turned over. So we're really at historical extremes in terms of overweight growth here. So regardless of what's happened over the past few weeks, we have to put things into perspective. And there might not be much more room to run in terms of growth just because of where we are historically. So if you're concerned about that, we do have a solution at McNichol & Associates with our partners at Universa, so please reach out to us with regards to that. So that's it for me this week, David.
Okay, great, Gilbert.
Can I make one short comment?
Yeah, go for it.
Absolutely.
Okay, guys, like the yen just moved in one day 2.3%. That is a staggering move for a currency. 2.3% in a day. This is like another intervention. Paul Tudor Jones on a great podcast he did a couple of days ago just said, like, watch the yen, and here it is. Like, stuff's going on underneath, outside of what we watch on a normal basis. But again, another staggering move for an asset that few of us pay attention to, but this is like going to lead to the complete unwind of the yen carry trade. And as Japanese rates rise to levels that are at par with the US interest rate levels, that what's been like one of the biggest trades of our investing lifetimes is coming to an end. And that will mean that one of the biggest buyers of US Treasuries is essentially going to just buy domestic JGBs.
Mhm.
So I don't see how people can predict 0% on the US 10-year, but we'll see. Anyway, that is just a big move. Just wanted to highlight that. That's all.
Yeah, I agree. I think that's a crazy prediction to go to 0%, but Trump, of course, would like it and feel that he's actually achieved something with that, but that just says the economy will just be a mess. Interesting. You don't really see it on these charts yet. So is this just today? You're talking about this 2.5% move?
Yeah, I've got it live right now, 156. Yesterday I was thinking I should take a position when it was above 160, which has been a line in the sand for the Bank of Japan. And the one thing I've learned in 30 years of trading is don't trade when you're sick. You tend to make bad decisions and take too much risk. And so I just left it, but 2% when you can get essentially 50 times leverage, that would have been a fantastic trade.
Mm-hmm. Yeah, here, I'll show it on point and figure here. So this is Japanese yen relative to the US dollar, and the trend is clearly down. And there's April 1st at 1 penny. Yeah, so that one, what is that? That measures down to chart low penny. It says it's bottoming out here. You could argue going way back here to 2024. That's as low as it got in July of 24. So that's interesting. But this one here shows the US dollar to the Japanese yen. So the inversion of that. This is the one you look at. I see $160.40. That was closed last night. But it doesn't look, from a point and figure standpoint, it doesn't look that meaningful. It doesn't, looks like if it got up to 161 and change, it could break out and start going the other way, or start going higher, I should say. But it does have a target of 176. So we shall see. Okay, that's enough for me, guys. Anything else? Okay, I'm going to sign off for now. So I'll talk to you all later. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnickelasset.com to learn more.